if you are like running a global supply chain right now, or even just keeping an eye on the markets, the traditional crisis playbook, when the world gets volatile, the instinct is basically to lock down.
Yeah, you build a bunker.
Exactly. You build a bunker, you hoard cash, you slash all the non-essential budgets, and, you just hold your breath until the storm passes.
It's a completely understandable reflex. I mean, when macroeconomic shocks hit, the traditional corporate posture is highly defensive. You contract, and you aggressively protect your tangible assets.
Right. But what if the data tells a completely different story? What if the strongest armor a company can wear during a massive global disruption isn't, made of cash reserves at all?
Well, the research we're looking at today suggests it's actually made of government structures and community trust.
Exactly. So today, our mission for this deep dive is unpacking a stack of recent corporate research, including this massive new CorpStage study that totally redefines how we look at environmental, social, and governance metrics. Because for the longest time, ESG has been painted as this, feel-good moral choice.
Just a slick corporate PR exercise.
Right. But the hard data we're looking at today completely flips that narrative. We are looking at ESG as a hard-nosed strategic asset for survival.
And before we get into the mechanics of that survival, we really need to set a vital ground rule for our discussion. The data we are analyzing today comes out of highly sensitive, highly politically charged geopolitical events.
Right, the really heavy stuff.
Yeah, specifically the economic shockwaves from the Russia-Ukraine war, U.S.-Israel-Iran tensions, and the massive global inflation spikes that resulted from all of that. So to you, the listener, we want to be completely clear. We take absolutely no political sides here.
Not at all.
Our sole objective is to impartially report on the cold, hard, financial and operational data from these sources, just to show how these specific events impact corporate resilience.
Okay, so let's unpack this, because the central premise here is fascinating, right? Companies are somehow transforming these intangible concepts like sustainability and social responsibility into tangible profitability when the world goes sideways.
Right.
So let's start with the ultimate stress test. I was looking at the Sang study from the Journal of Cleaner Production, and they look at top S&P 500 firms right around the milestones of the Russia-Ukraine war.
Yeah, a massive, immediate shockwave to global logistics.
Exactly. But they found that highly ESG-active companies weren't just surviving that initial shock. They actually experienced a higher incidence of abnormally positive stock returns while the broader market was taking a massive hit. And I'm struggling to see the mechanism there. I mean, they didn't just magically dodge closed airspaces, right?
No, it definitely isn't magic. It's structural mechanics. To understand why those stock returns stayed positive, you really have to look at how a focus on the social and governance pillars inherently changes the architecture of a company's supply chain.
Okay, how so?
Well, a traditional firm often optimizes purely for cost, which usually means, relying on a single mega factory halfway across the world just to get the absolute lowest price per unit.
Right, the efficiency obsession.
Exactly. But a firm prioritizing strong governance builds for resilience. They actively cultivate multiple suppliers, they mandate local sourcing alternatives within their region, and they implement highly rigorous procurement processes.
Oh, so when a sudden geopolitical shock completely cuts off a major global shipping route, they aren't scrambling to figure out what to do next.
Precisely the opposite of scrambling. They have the governance structures already in place to pivot immediately. They use multiple suppliers. They've already vetted local backups. I mean, their supply chain was designed from day one to absorb shocks.
Not just to operate on razor-thin margins during perfect weather. Okay, that makes sense for the supply chain routing. But what about the E in ESG? How does a company's environmental policy actively hedge against a geopolitical conflict? That sounds like a stretch.
What's fascinating here is how the energy transition acts as a literal financial shield. Think about what happens during a major conflict.
Everything gets super expensive.
Right, but specifically commodity prices. Oil and gas go absolutely through the roof. But if you are a company that has heavily invested in energy efficiency or, you've transitioned parts of your operation to renewables like on-site solar or wind, you have systematically reduced your reliance on volatile fossil fuels.
Oh, wow. I see where this is going.
Yeah, so when that geopolitical shock triggers a massive spike in energy prices, your operations are effectively hedged. Your overhead doesn't spike nearly as much as your competitor, who is still entirely reliant on grid power and diesel transport.
Okay, I have to push back on this a little bit, though. Local sourcing, vetting backup suppliers, trying to lower your long-term energy costs. Isn't that just business 101? good, smart managers have been trying to do that for decades. Why do we need the ESG label for it? It sounds like ESG is basically just a corporate shock absorber that we've given a fancy new name.
Well, the shock absorber analogy is incredibly accurate, actually. But what's fascinating here is the distinction between a good manager's intuition and an actual ESG framework.
Okay, what's the difference?
The framework forces a company to formalize those Business 101 practices into mandatory, data-driven operational standards. Instead of just hoping that a regional director took the initiative to diversify their supply chain, strong ESG governance mandates annual stress tests.
So it takes it out of the realm of chance.
Exactly. It requires documented scenario planning. It writes diversification directly into the corporate bylaws. It takes these vital survival tactics and turns them into a guaranteed operational capability that is tracked and measured at the board level.
So it's the difference between having a fire extinguisher somewhere in the building versus having a mandatory audited fire suppression system built into the walls.
That is a great way to look at it. Though, to maintain our deep dive's balanced perspective here, it is important to note the limitations of the Song study we just talked about.
Right, what's the catch?
Well, they only looked at U.S. large caps, the S&P 500, and because you can't run a controlled, randomized trial on a global conflict, researchers have to infer causality from these event windows.
Makes sense. But the correlation is still super strong.
Very strong and very consistent across hundreds of firms.
Which brings us to the inevitable second act of any global disruption. So, if diversified supply chains protect you from bombs and borders, what protects you from the silent margin killer that follows? Like inflation.
This is where we see the immense power of social capital.
Social capital. Okay, how does that work as an inflation armor?
Well, there's a great panel data study by Monteferro and Ramelli looking at U.S. firms during the massive inflation surges of 2021 and 2022.
Oh man, that was a brutal time for margins.
It was, but a very clear pattern emerged in their data. Companies that had accumulated strong social capital, which they measured via corporate social responsibility performance, saw significantly higher market valuations after those inflation spikes compared to their peers.
But why? Why would a company's social responsibility make its stock more valuable when inflation is basically eating everyone's purchasing power?
Yeah.
Are investors just feeling generous?
It has nothing to do with generosity, actually. It has everything to do with pricing power. Analysts understand that socially responsible firms are fundamentally better at preserving real cash flows during an inflationary period.
Because people like them more.
Basically, yes.
Yeah.
They have built a massive reservoir of stakeholder trust. Let's walk through the mechanism. When the cost of raw materials goes up, a company eventually has to raise the price of its product.
Right, you can't eat the cost forever.
Exactly. But if consumers feel zero loyalty to that brand, or if they don't trust the company's motives, the moment that price goes up, the consumer jumps ship to a cheaper competitor.
Yeah, they just look for the lowest number on the shelf.
Right. But the data shows that customers stick with highly ethical, trusted brands during economic downturns. They are willing to absorb that price increase because they believe in the product or the company's mission.
Wow, so that allows these trusted companies to pass through their unavoidable cost increases without suffering a massive loss in market share.
Exactly. Social capital literally buys you the loyalty needed to raise prices without triggering a customer revolt. Furthermore, in wartime or severe crises, socially responsible firms claim much higher legitimacy, and they enlist a lot more community support.
I imagine that dynamic extends well beyond the retail checkout aisle, right?
Right.
It has to impact workforce too.
Heavily. Employees genuinely want to work for companies they believe are acting responsibly. So when inflation drives up the cost of living and wage demands skyrocket, companies with strong social capital find it significantly easier to retain top talent.
Which reduces turnover costs during a period when hiring is already incredibly difficult. Now, we've been talking a lot about U.S. markets. Does this hold up globally, or is this social capital concept a uniquely American thing?
The broader data confirms this is absolutely a global mechanism. For example, the Abu Bakr study looked at listed companies in Thailand and showed the exact same trend. Higher ESG scores positively impacted profitability metrics, like return on assets and return on equity.
Oh, wow.
Yeah, and Yin's research on Chinese firms found that superior ESG performance directly drives higher stock returns. So whether you are in Bangkok, Beijing, or Boston, the global context shows that sustainability protects cash flow.
So what does this all mean? If I'm understanding this correctly, being a good corporate citizen isn't just like warm and fuzzy. It literally buys you the loyalty needed to survive.
That is the exact takeaway. The ESG framework transforms intangible trust into tangible cash flow.
Okay, I love the theory, but I need to play devil's advocate here.
Go for it.
Because anyone who has spent 10 minutes in the corporate world is going to spot a glaring issue. Trust, supply chain pivots, social capital, that all sounds fantastic. But how do you actually prove to the market that you're doing this? Like, how do we know it's not just a glossy 50-page PDF with pictures of trees? How do we know it's not greenwashing?
That is the multi-trillion-dollar question, and it's exactly where the new operational frameworks come in. The source framework introduces a very specific solution to this exact problem, the Certified ESG Controller, or CEC.
A certified ESG controller. Okay, so is that like a financial controller, but for sustainability data?
Exactly. It's a dedicated role with a mandate to set rigorous ESG data standards, coordinate internal audits, and crucially, integrate those metrics directly into financial reports.
Okay, applying audit-level rigor to carbon and supply chain data. But does just hiring a controller actually fix the data integrity issue?
The data suggests it does in a major way. The text drops a highly revealing statistic. Companies that operate with an empowered ESG controller report a 75% confidence level in the integrity of their ESG data.
Okay, 75% is pretty solid.
Right. But for companies attempting to manage this without a dedicated controller, that confidence level plummets to just 45%.
Wait, 45%? That is functionally useless. If a company's own leadership is only 45% sure their supply chain data is accurate, why on earth would an outside investor or a bank believe them?
They wouldn't. And that's why the controller role is so vital. They track hard operational metrics, like data integrity metrics, which targets zero material errors in public reporting.
Zero errors.
Yeah. And they track risk metrics, like supply chain assessments, and outcome metrics, which explicitly correlate ESG improvements with better credit ratings or lower insurance premiums.
It's basically having a CFO for your company's conscience and supply chain. And I guess part of this is upskilling your existing finance teams, right? You teach the people who already understand enterprise risk how to do carbon accounting.
Exactly. That builds serious internal muscle. You aren't perpetually reliant on expensive external consultants. And if we connect this to the bigger picture, this level of data governance is what allows companies to secure risk-adjusted capital costs.
You mean like getting better rates from banks?
Exactly. Lower borrowing rates, cheaper insurance premiums. Because insurers and lenders actually trust the risk profiles when they're signed off by an ESG controller.
Okay, here's where it gets really interesting, though. Because the immediate pushback from skeptics is always going to be about the price tag. I can hear you, the listener, thinking right now, hiring controllers, running internal audits, tracking carbon. This sounds incredibly expensive. Let's talk about the cost.
It's a very common pushback. The myth that ESG is just a costly distraction from shareholder value.
Right, and the sources provide a really illuminating case study on this. They look at the massive ROI of transparency through an ExxonMobil 10K disclosure.
Yeah, this is a fascinating example.
In their regulatory comments to the SEC, Exxon noted that compiling these complex disclosures was a massive undertaking. They estimated it took about 20,000 employee hours. And critics jumped on this, crunching the numbers. At, say, $250 an hour, that's roughly a $15 million compliance cost just to generate a report.
And in a vacuum, $15 million sounds like a very heavy burden.
That sounds huge.
But you have to contextualize that math. First of all, $15 million represents roughly 0.005% of Exxon's annual revenue, which sits well over $300 billion. It is functionally a rounding error. But far more importantly, we have to look at what that $15 million investment actually buys the company.
They aren't just burning the money. What's the actual ROI?
It secures their position in the broader financial ecosystem. Maintaining an S&P 500 listing brings higher trading liquidity and a marginal price-to-earnings boost. Analysts estimate the value of that specific listing advantage for a company of that size is anywhere between $290 billion and $390 billion in market capitalization.
Wait, let me make sure I'm following the math here. They are spending $15 million in compliance costs to secure up to $390 billion in market value.
Yes.
That is insane.
When you calculate that out, it creates an astronomical return on investment. We're talking about an ROI of 19,000 to 26,000 to 1, entirely driven by the compliance and transparency spend.
A 26,000 to 1 ROI.
Exactly. It completely debunks the myth that ESG is too costly. As Forbes and Columbia Business School professor Shivaram Rajgopal highlighted, the market assigns far more value to transparency and governance than the actual cost of the
It
compliance.
totally reframes compliance from being an annoying tax to being a highly leveraged strategic investment.
It does. But to maintain our analytical rigor here, we cannot treat ESG as a flawless magic wand. There are critical limitations.
Okay, what's the downside?
Well, some of the advanced market research highlights an inverted S-curve. The Wu study on Chinese A-shares showed that while initial ESG investments massively boost intangible capital like brand, reputation, and innovation, these gains do eventually taper off at very high levels.
Diminishing returns. So you can't just infinitely pour money into community projects and expect your stock to rise infinitely.
Precisely. And furthermore, the Dewang regime switching model shows how this plays out in total market meltdowns. ESG shields against downside volatility in normal markets.
Right, it acts as a buffer.
But that advantage does dissipate during extreme market crashes. ESG is a capability, not gravity-proof armor. If the entire global financial system crashes, everyone's stock goes down.
That is a really vital caveat. So as we pull all of these complex threads together for you, the listener, what we are really looking at is a total paradigm shift. ESG is no longer a side project for the PR team. It must be embedded directly into corporate strategy, into KPIs, and into capital allocation.
Right, like directing 20% of new capital to decarbonization.
Exactly. From surviving the supply chain shocks of a global conflict, to using social capital as an inflation hedge, to proving it all with an ESG controller. ESG is a core driver of crisis-era profit.
Excellent.
So the next time you hear someone say ESG is just a cost center, you can point out that a global meta-analysis of 233,000 firm-year observations proves them completely wrong. For every dollar spent on sustainability, companies see multiplied value in efficiency, loyalty, and risk reduction.
And this raises an important question for you, the listener, to mull over as we look toward the future.
What's that?
Well, if the initial investments in ESG create this inverted S-curve of highly valuable intangible assets, brand, trust, resilience, will we soon reach a point where a company's intangible ESG equity is actually valued more highly by the market than its physical factories and tangible assets?
Man, a total inversion of how we fundamentally value a business. That is something to chew on. We started this deep dive talking about the traditional corporate bunker, right? Thick concrete walls, hoarding cash.
Yeah.
But it turns out the data proves the best way to survive a global storm isn't a static wall at all. It's a dynamic, highly transparent, deeply trusted system. Thank you so much for joining us on this deep dive. Keep questioning the data, keep looking beneath the surface, and we will catch you next time.